As you move from Canada to the US, there are certain things you must avoid and certain things that you must do at all costs. In this video, we will talk about all of those things, including TFSA, RRSP, your Canadian properties, your driving license, and your OHIP. After that, we will discuss what you need to do at the tax filing time in both the US and Canada. Let's get into the video. Hi, my name is Sal, and me and my team help Canadians moving to the US with the Canadian and US tax filing so that they do not get double tax. So starting with number one, TFSA. You must close it. Why? Because in Canada, a TFSA is tax-free, but in the US, it is not. In fact, it can be treated as a foreign trust in the United States, and the reporting requirements for trusts outside of US are very, very complex. So you do not want to end up filing forms that are meant for billionaires who have trust in Panama and Cayman Islands and all of that stuff. So in simplicity, close your TFSA. It's not going to give you any tax benefit in the United States, and it only will complicate things for you when you move there. So move that money out, invest it in your RRSP, or invest it in the USA when you move there in one of their plans. Number two, cancel your OHIP. Once you leave Canada, you need to declare yourself as a non-resident for tax purposes. Because if you do not, Canada may continue to tax you on your worldwide income, even if you're living in the USA. So you need to formally declare yourself as a non-resident of Canada. Here's the catch. If the IRS audits you, they often look at whether you severed all your ties with Canada. Guess what is the one thing that all Canadians forget when they're leaving the country? They forget to close the OHIP or provincial coverage. If it's still active, they'll argue that you still intended to maintain ties and they could tax you accordingly. So cancel the OHIP, cancel it for yourself, for your family, and you can literally just do this online by mail or going through to Service Ontario. Number three, having properties in Canada. Now this is completely fine as long as your spouse and kids are moving with you. Later in the video, we touch upon what happens if they are not. But for now, let's talk about this scenario. Just know that from the day you leave, that property will no longer qualify as your principal residence. And any capital gains after this will be taxable. So it's a good idea to get a real estate valuation done so that you know what the value of your property was on the day you left. I had a client whom the CRA wanted to see proof of the value of their property the day they left. Because at this point, it is now converted from being tax-free to now being capital gains tax eligible. So if you brought your property at $1 million, the day you left Canada, it was $1.2 million. And then 2 or 3 years later, if you sell it, it's let's say $1.5 million. Now, the CR is going to tax you from the 1.2 till the 1.5. And to prove the value on the day you left, you need to have a valuation. So you can get this done formally by a valuation company, or at the very minimum, go to housesigma.com, get screenshots of properties that were sold around the same time that you left and which had the same sort of specifications that your property right now has. Talking about property, you're probably going to now rent it out. The CRA requires taxes to be withheld on that rental income before the rent comes to your pocket. It's just that they do not trust non-residents to file and pay their taxes once they've left Canada. For this, you need to register a non-resident account. So just go to Google, search open a non-resident tax account CRA, head to this page, and it will guide you through everything else. Bear in mind, to do this, you will need a friend or family member, colleague, anybody who's based in Canada and agrees to be your agent. This agent has the responsibility to take the money from your tenants and send CRA's part to them before sending the rest of the money over to you. Perhaps your realtor would want to do that. So now let's talk about how much tax you have to remit to the CRA. You have two options here. The CRA would either have you pay 25% of your entire rent or 25% of the profit. Option one is the 25% of the rent. So example, you're getting a rent of $2,000 every single month. They require you to remit $500 to them every single month. You're probably wondering at this point, well, that's way too much. My tax should probably be 25% of my profit or even sort of lesser than that. And I understand that. A lot of times in these scenarios, given the high mortgage interest rates, you might not even have any profit left. Why does the CRA want 25% of your rent? The thing is, like I said, they do not trust non-residents. So they ask you to give everything up front And at the end of the year, you file a tax return to calculate the exact amount of tax you owe them and get everything back. This is a Section 216 return. It's like a Canadian T1 personal tax return and can be done by most cross-border accountants, including my team. The option number 2 is, if you're short of cash and you would like to not pay this much upfront, you can file an election to be taxed only on the profit. And in some cases, like I said, high interest rates, you might not even have any profits. So you would not pay anything until the end of the year if there's a small amount to pay. This election is called a NR73 return, and it needs to be filed before you receive your first month's rent for that year. So let's say you're moving in August of the year, it needs to be filed before you get your August rent. Or if it's a new year, then before January 1, so rent is due to you. The form asks you to list your best estimate of your income and your expenses for the upcoming months, and once it's been submitted, you're only required to pay tax on 25% of the profit. It's very important to note that this process takes months because there's a lot of backlog with the CRA, and you want to wait this out to know for 100% confirmation that they have accepted it and you're only required to pay that smaller amount, not 25% of the entire rent. Number 4, your car. Most US states allow you to keep a Canadian vehicle in the US for up to 1 year. After that, you'll likely need to swap it through a dealership. So basically, let's say if you got a Toyota, just go to Toyota and they'll give you a US-based Toyota, or make modifications to your car to keep it in that state. You want to check with your local state for specific rules. Number 5, Canadian tax filing. So if your family is moving with you, you'll need to file a departure return. This is telling the CRA that you're ending your Canadian tax residency. And yes, we do take care of all of that for you. We'll declare the date of departure, we'll list your assets as of that date, and if you have properties, real estate properties, we'll give the fair market value to the CRA on the day you leave. Now, what about if your kids and spouse are staying behind? The CRA will likely think that your home is still based in Canada and you should still pay Canadian income tax on your US income. So there'll be no departure tax required, but do bear in mind that you will have higher tax to pay in this scenario. Why? Because Canada in general is a higher tax country than the United States. So for example, if you have $100,000 of income, the US taxes you $20,000, Canada would probably assess your liability as $30,000. If you go to a US-Canada cross-border accountant, we make sure that you do not get double tax. So you're not paying $20,000 to one country and $30,000 to other. You're only paying 20 plus the extra 10, right? So in this case, there's still avoidance of double tax, but you're still getting more tax just because Canada is a high tax country. So do bear that in mind when you're leaving your kids behind, that there'll be a higher tax liability. Number 6, the US tax filing. So in the US, you'll either need to file a non-resident tax return or a part-year resident return, depending on how long you were in the US that single year. So if you were less than 183 days in the US, you're non-resident. So for example, if you move between July to December, you'll be a non-resident for that year. If you move between Jan to June, you're considered a full year resident, but you have to file a dual status return. This is something that US accountants don't know about, but it's actually something that's very, very common in cross-border scenarios. This dual status return, what it does is, it tells the IRS that I'm a resident for the latter half of the year, but for the first few months of the year, you should not be taxing me on my income because I was in Canada and I've already been paying tax of this in Canada, and I'm not a resident of the United States. So that was the federal filing for the states. So up until now, we've discussed a bunch of things. We've talked about your investments, your property, your OHIP, and your Canadian tax filing as well. Continuing with the US tax filing part, there is a state tax return in the United States as well. So you need to file your federal income tax return to the IRS, but also a state tax return. The good thing is some states have no income tax, such as Florida and Texas, so you have no state income tax return. Most other states like New York, California, and a lot of others do have them. So you have to file 2 separate tax returns here. So let's talk about deadlines. The US requires you to file taxes by April 15th, which is 15 days earlier than Canada, but it is very common and very easy to file an extension to extend this deadline to October 15th. So you have an extra 6 months. This is automatically accepted and it's something that's very, very commonly done in the United States. Just bear in mind, we at Sal Accounting can help you with all of that. The Canadian tax filing, the US tax filing, and even the stuff that I'm going to talk about right now. Which brings me to number 7, the ITIN. The International Tax Identification Number is for people who are not US citizens or green card holders. It's like a SIN, but for the United States. You'll need to apply for a SIN, and this is done along with your first tax return, and it's done by attaching a Form W7. I'm going to talk about this in a different video, and I'm going to put the thumbnail for that here and at the end of this video so you can check it out. Let's move on to number 8, foreign bank account reporting. The US government requires that if their residents have more than $10,000 in foreign accounts, for example in Canada, you'll need to report it in the foreign bank account report, also known as FBAR. If you move to the United States between July to December, I mentioned that you will be a non-resident, so you do not have any FBAR reporting requirement to them. But if you move between Jan to June, you likely might have some funds that you left in Canada. If they're over $10,000, so roughly 14,000 Canadian dollars, then you need to file a FBAR as well. This is not a tax, it is just a disclosure requirement. You just need to list out your Canadian bank accounts and their balances on the last day of the year. The US just wants to know where its residents have their money parked, because you could have millions sitting outside and they just want to know about it. The deadline for this is in October, so you do have a few extra months. So to recap the entire video, the few things you need to do is close your TFSA before you move, cancel your OHIP or your provincial health coverage, check your vehicle rules in the state you're moving to, file a departure tax return if you're moving along with your family, file an entry return in the United States, and finally, disclose your foreign bank accounts in Canada if they're over $10,000. That's it. We hope this helps, and as always, we're here to guide you through every step of your cross-border tax journey. Subscribe to the channel to get more tips like these sent to you. If you hit the bell notification icon, you're going to get notified when I upload a video, which is usually every Wednesday. See you in the next one.